Hello everyone and welcome to the next class for Index 33. So today we would be doing an exam question, that was question number 17, which involves multiple potential equity shares. So if there are multiple potential equity shares, how does it matter? You will include all of them in the EPS calculation. Well, yes, you should. However, in certain cases, what might happen is it might not really give you the correct diluted EPS. For example, we have on page number 73, before we even read the theory, I would want you to go through this example please on page number 73. Let us go through this example once. So we have the PAT for equity shareholders after deducting the preference dividend is 1 lakh rupees. The VANS, that is weighted average number of equity shares, is 10,000 rupees. Remove an extra zero over here, it is 10,000, which means the basic EPS, if you go to see, is rupees 10. Okay, there are 12% preference shares of rupees 10,000. One preference share converts into 0.1 equity share, and there are 2% debentures of rupees 10,000, and one debenture converts into one equity share. So you have to calculate the diluted EPS. So one would say that how does it matter if we calculate the diluted EPS? Let us try to take the diluted EPS. The basic EPS is 10. And you will take the numerator, which is 1 lakh rupees. If both the potential equity shares are to be converted, so this is, let's say, 10,000, that is, you will no longer pay any preference dividend, so that is 12% of 10,000, that is 1200, and against that you will issue face value is 10 each, so you will issue 1000 preference shares ke samne 1000 into 0.1, so this is 100 equity shares, and you will issue 2% debentures. So when you look at 2% debentures, are you given a separate tax rate? No, so we will directly take 2% of 10,000. So I guess this is 200, and one debenture converts to one equity share. So this will be, face value is rupees 10. So this is 1000 equity shares. So if you take the numerator, this is 1,01,400 divided by 11,100. And if we calculate this, 1,01,400 divided by 11,100, we will get 9.135, I guess, and hence this will be your diluted EPS. Okay, but is there possibly an EPS which is worse than that? No sir, we are assuming that we are taking both the potentially convertible shares and finding the diluted EPS. But my point is there a possibility that the EPS can even be lower than this? So we have taken both of them. Well, what if one of them is anti-dilutive and one of them is dilutive? Sir, but how will we understand? And even if we understand, how will we know which of the two should be taken first? And hence a mechanism is given. So over here, if you go to see, we have done some working, and at the end of this working, you can see diluted EPS is 9.11. Now it might be a small difference, 9.13 and 9.11, but at the end of the day, there is a possibility where you can get an EPS which is lower than 9.135, and hence we should know how do you solve for diluted EPS if there are multiple potential equity shares given. Well, there is a method given whereby you will have to solve on a step by step and a cumulative basis. What does this mean? It means that you will not take all the potential equity shares blindly. You will take one potential equity share at a time and find out whether the EPS on inclusion of that potential share, for example, debenture, you will take only debenture, not the preference shares, and you will find out whether the EPS is dilutive. If yes, then on a cumulative basis, then you will take the second. If it still falls, then you will take the third, and so on. Yahan pe to there are just two instruments, and hence you can even do trial and error. You can first take debenture, then take preference share, or you can take first preference share, then debenture. You can do trial and error. But what if there are more than two? And hence we need a foolproof way to solve this. And hence there's a method which is given where there is a hierarchy or an order of dilution which is available. The first step over here is to find out what is called as incremental EPS for each potential equity share. So the incremental EPS over here would be the cost saving. So for example, the cost saving over here is 1200 upon the number of additional shares. This is 100, and hence the incremental EPS comes to 12 rupees. Acha. Second, for the second instrument, you will take 200 upon 1000. So let us say this is 0.2. So the first step involves calculation of incremental EPS. What does incremental EPS mean? It means for every one instrument that is converted, how much is the cost saving per share? Well, for the preference shares that are converted, the cost saving is around 12 per share. That is a big cost saving. Whereas for the debentures that are converted, the cost saving is barely 0.2. Which means, which of the two do you think is more dilutive? Which of the two is almost certainly going to result in a dilution? Well, it is debenture, because if when I add 1000 in the denominator, effectively barely 200, or when I add one instrument on conversion of the debentures in the denominator, I add just 0.2 in the numerator. And as a result, this has a power to pull down the EPS much more than in case of a preference share. When I add one convertible preference share, I am adding 12 in the numerator, and hence I will rank these securities. Second point, I will rank these securities in the ascending order of their incremental EPS. So first will be debenture, second will be preference share, because debenture has more dilution capabilities. Once you have ranked this, then you will calculate the diluted EPS on a step-by-step basis, taking one security at a time, which means you will start, let us say, at 1 lakh, which is, let's say, the profit, 10,000, which is a number, and hence this is rupees 10. However, when you will consider the debentures as well, then in the numerator you will add 200. In the denominator you will add 1,000, which means you will take 1 lakh, 200, and you will take 11,000. And you will have 1 lakh 200 divided by 11,000, which will come to, let us say, rupees 9.11. Is this dilutive? Yes, because it reduces the EPS below rupees 10. Okay. Now, since this is dilutive, you will go to the preference shares, the second item. So when we go to the preference shares on a cumulative basis, so debentures have been proven to be dilutive. Now, when you look at preference shares, they could be dilutive, they may not be as well, depending on the numbers. So this is 1200, and here on conversion you get 100, which means the total profit will be 1 lakh 1,400, and this will be 11,100. If you divide this, this is around 9.13, which is anti-dilutive because it is increasing. Sir, it is still lower than the basic. Does not really matter. It is higher than 9.11. Diluted EPS is the worst or the lowest possible EPS. So over here, this is anti-dilutive, and hence this is to be ignored. In fact, preference shares are considered to be anti-dilutive and will be ignored from the diluted EPS calculation. In fact, your diluted EPS will be then taken as 9.11 only. Are we clear with this? Yes, okay. So what we have done over here is, if we read the theory on page number 73, the order of solving in case of there are multiple potential equity shares. First, you will calculate the incremental EPS for each potential share separately. The incremental EPS is cost saving upon the number of shares or free element, as the case may be. Second, rank the securities in the ascending order. Why? The lowest will come first because they have the maximum dilution power. In the ascending order, that is the most dilutive securities are ranked first. Third, solve for the diluted EPS on a step-by-step cumulative basis, that is one by one, by including one potentially convertible security at a time, one at a time, in the order of ranking. If the resultant EPS falls, then the security is dilutive, but if it rises, the security is anti-dilutive, and hence the diluted EPS is calculated without that security. Like over here, you have calculated, let us say, the incremental EPS, step number 1 for preference shares, and then for debentures. Then you have ranked it, step number 2, and then you have taken step number 3 and 4, where we have taken one security at a time, found 9.11, said that it is dilutive, found 9.13 or 14 as a case maybe, and said this is anti-dilutive, and hence your diluted EPS is at 9.11. Okay. So considering that, we will go to question number 17. There is one additional point in question 17 which pertains to DDT, that is dividend distribution tax. As you are aware by now that the DDT has been abolished. However, we don't know, institute might ask an adjustment with DDT as well. All you have to know is DDT is paid on dividend. Whether that is dividend on equity shares or dividend on preference shares, DDT is legally supposed to be paid on dividend, or it was supposed to be paid on dividend, whether on equity shares or preference shares. It is not paid on interest. Acha, was DDT a cash outflow? Well, yes, and hence if you were to pay a dividend of 100 rupees, let us say preference dividend of 100 rupees on convertible preference shares, you would have paid, let us say if DDT is 10%, then on that 100 rupees of dividend, you would have paid 10 rupees of DDT. So if the preference shares convert, you will save 100 undoubtedly, but you will also save that 10 because you will not have to pay any DDT. And hence the cost saving in case of a convertible preference share will be 100 for the dividend as well as 10 for the DDT, and hence it will be 110. Sir, but these preferences we have classified as liability. That is as per IND AS. Company Act does not do the recording, and legalities are not seen based on IND AS. It is seen based on the legal structure. So the Income Tax Act and the Companies Act acknowledge that preference shares are shareholders and hence they are owners, and if payment is made to the owners in the form of dividend, then DDT is to be levied. So you will also have to consider DDT in your assessment, like we will do in question number 17, which is an important question. Okay, so let us go to question number 17, please. Page number 126. The following information is available regarding Space India Limited for its financial year 1920. The net profit available to equity shareholders is 90,000. The number of equity shares outstanding is 16,000. The average fair value of one equity share during the year is given to you as 90, and there are potential shares which comprise of options, which has 900 options with an exercise price of 75, convertible preference shares 7,500 shares entitled to a cumulative dividend of 9 rupees per share. Each preference share is convertible into 2 equity shares. Okay. Applicable corporate dividend tax. So this is DDT given in the question. It is now abolished, but nevertheless, if it comes, you should be aware how to solve it. And then there are convertible debentures of rupees 100 each. These are 10 lakh rupees, where each debenture is convertible into 4 equity shares. The tax rate is given to you. You are required to compute the basic as well as the diluted EPS for the company for the financial year 2019-20. So this is a fairly interesting as well as important question. Please go through the question once. Aja, if you have gone through the question, you have to calculate the basic EPS. Basic EPS will be calculated, let us say, as the net profit available to shareholders. The question tells you this is net profit attributable to equity shareholders. This is not just net profit. This is not no profit. This is net profit attributable to equity shareholders, which is 90,000. Remember, if it is net profit, it has to be after interest. However, preference dividend depends on how you classify, whether preference shares are for classified as equity or financial liabilities. But if it says it is net profit attributable to equity shareholders, this means it is even after the preference dividend. This is the profit available to equity shareholders. You divide this by the number of equity shares outstanding. There is no other fresh issue of shares, and as 90,000 divided by 16,000 will come to 5.625. This will give you the basic EPS. Okay. Now the important assessment of diluted EPS. Now there are 3 potential equity shares, and hence you will have to follow the steps, where first you will try to find the incremental EPS. अच्छा, incremental EPS सबसे पहले अपन options का निकालेंगे. Options में there is no cost saving in the numerator, divided by in the denominator. What do you take? Well, in the denominator you don't take all the options, you take only the free element. And how do you calculate the free element? Well, there are 900 options which will result in 900 shares. However, if 900 options are exercised, we will get 900 into 75 rupees in our pocket. What do we do with this 900 into 75? We will buy the company shares, and these company shares in the market are available at 90 rupees, the average fair value. And hence 900 into 75 divided by 90 will come to 750. That is 900 minus 750 will come to 150. So there are 150 potential equity shares for the options. 0 divided by any number is going to be 0. This is for options. Then you have convertible preference shares. How many convertible preference shares are there? Well, these are 7,500 shares entitled to a cumulative dividend of 9 per share, which means 7,500 into 9. 7,500 into rupees 9 is a cost saving. However, there is also a DDT. Each preference share is convertible into 2 shares, but there's a DDT of 8%. Now, I'm aware that in income tax there are grossing up provisions also which are there, but Institute ignores grossing up for simplicity over here. It says if it is 7,500 into 9, that is 67,500, then 67,500 into 9% will be giving you the preference dividend. Having said that, as per the strictest provisions of the Income Tax Act, grossing up provisions can also become applicable, though we are not studying income tax law again. So these 7,500 preference shares will convert into what? Well, each preference share will convert into 2 equity shares, and hence this is 67,500 that you will save, plus also 8% of 67,500 that you will save. Acha, divide this by 15,000. Divide this by 15,000. So over here, this is 67,500 into 8%. This is 5,400. So this is 67,500 plus 5,400 divided by 15,000. So this will be 72,900 divided by 15,000, which will be rupees 4.86. This will be rupees 4.86. Okay, so this is your incremental EPS. Over here, this is 0. Here, this is 4.86. Then look at convertible debentures. Convertible debentures will have rupees 10 lakhs. And this is 10%. There is no market rate of interest on similar non-convertible debentures or no market rate of interest on similar non-convertible preference shares given, and hence we can't find the liability component as such. So this will be rupees 10 lakhs, and 10 lakhs के ऊपर आपका interest कितना है into 10%. So this will be the interest saved. But here you don't have to pay TDT. However, interest is allowed as a deduction while calculating income tax, and as a result, if you are assuming conversion at the start of the year, then this interest will not be paid, and hence your taxable profit will be higher, and hence your cost saving will be the net of tax. There will be a saving because you're saving in interest, but because the profit increases, you will have to pay a higher tax. So the net of tax amount will be taken. Acha, what is the face value for each debenture? This is rupees 100. So this is 10 lakh rupees, which is equal to 10,000 debentures of rupees 100 each, and each debenture is convertible into 4 equity shares. So this is 10,000 into 4, and as a result this will be rupees 1 lakh, or rather 1 lakh into 0.25. So this is 75,000 upon 40,000. So this will come to 75 upon 40, which will be 1.875. So that gives you the incremental EPS for all the 3 types of securities. Now what you will do is you will try to find the ranking which is the most dilutive, options being the most dilutive because they are not resulting in any cost saving, followed by the debentures and then followed by the preference shares. So you have determined the ranking. Now once you do the EPS calculation, you have to do that on a step-by-step basis. So you start, let us say, at where the basic was. And in the basic, in the numerator, you had, I think, 90,000, and in the denominator, you had 16,000. And hence, this is 5.625. To this, you will first just add the options. Due to the options, there will be no addition in the numerator, but in the denominator, the free element, which I guess it was calculated as 150, will be added. Okay, which means that EPS over here would be 90,000 divided by 16,150. No matter how small the fall is, there has to be a fall. So this is 16,150. At least there should not be a rise. So this is 5.573. So there is a fall, and hence this is considered to be dilutive. And hence we can go to a step further, where you will now take convertible debentures. Okay, remember the order is important. We have determined the order based on the ranking, because if you swap the order, it might happen that one security which you were counting to be dilutive is actually anti-dilutive, or vice versa. So over here on convertible debentures, ultimately the interest saving is 75,000. That's a big saving, but then you are going to add 40,000 to the pool of shares. So that's quite a big addition, in which case we have 1,65,000 का profit to be shared between 56,150 shareholders. So this is 165 upon 56,150, which will come to 2.934, which is definitely a fall. So this is also dilutive. Plus we look at convertible preference shares. Acha, if we look at convertible preference shares help us in saving, I think 67,500 plus 5,400, 72,900. They help us in saving 72,900. However, they come at an additional cost of 15,000 shares being issued, and as a result, if these preference shares are converted, you are saving 72,900, so that's 165 plus 72,900, this is 2,37,900, and you are having 71,150 shares. So this is 237,900 divided by 71,150, and hence this is coming to 237,900 divided by 71,950 or 71,150, which is 3.765. 237,900 divided by 71,150, 3.34. So this is rupees 3.34, which is basically higher than 2.934, and hence we can see that these are anti-dilutive. And hence preference shares will not be taken, and your diluted EPS is the worst possible EPS, which is 2.934. Therefore your diluted EPS is 2.934. Sir, kya farak padta hai? If we interchange the order, how does it make a difference? I'll just show this to you. So for example, this was 90,000 and 16,150 with the options. Now if you take convertible preference shares first, what will happen is this will appear as 72,900 and this will appear as 15,000. If you take convertible preference shares first, which is wrong, but this will be 1,62,900 divided by 31,150. So अभी आपका EPS कितना हुआ है? 5.57. So this is 5.57. Now we have 162,900 divided by 31,150, and hence this comes to 5.22, and you will come to the conclusion that these preference shares are also dilutive. They are also dilutive, and then you will add debentures. This is 75,000. You will add 40,000, and hence this will again come to 237,900, and this will come to 71,150. If you take this, तो ये आपको number देगा 3.34, and you will say कि हाँ 3.34, which means it is further lower, and hence it is dilutive. So if you take convertible preference shares first and convertible debentures later, you will assume that preference shares are also dilutive, debentures are also dilutive, whereas as a matter of fact, preference shares are not. Once you add the debentures and then you try to add the preference shares, you will get the worst possible EPS. The worst possible EPS, as you can see, is 2.934. ये working में 2.934 आएगा ही नहीं, but आपको समझेगा ही नहीं ऐसा कोई possibility था. And hence the ranking is important. I hope you are understanding the concept. Okay, so that takes care of an important assessment on question number 17. Now you go to question number 18, but before that we can also try a practice question. Now what might happen sometime is inclusion of a potential equity share may make the diluted EPS anti-dilutive, and hence you should not include it. However, when we look at the presentation of the EPS in the income statement, you have to remember that the EPS is presented on the face of the income statement, and what is presented, both the basic and diluted. Perfect. But is that it? Well, you have to present the EPS from continuing operations, from discontinued operation that you would have studied in IND AS 105, and then from total operations. You have to present both the basic and diluted for each of them. Sir, to ठीक है, present कर देंगे. How does it matter? Is it necessary that there has to be discontinued operation? No, but can there be? Well, yes. If during the year you have discontinued an operation, or you are holding a particular segment for sale, it is to be treated as discontinued operation, and you would have studied in IND AS 105, then the profit of such an operation has to be shown separately. ठीक है, वो दिखा भी देंगे. What is a big deal? Okay. Now what might happen is the inclusion of a potential equity share may be dilutive in one of these numbers, may be anti-dilutive for the other numbers. Sir, nahi samajh mein aa raha hai. I'll just take you to a practice question which is there in your volume number 2. You can just focus on the screen, don't really shuffle around the books. You can just focus on the screen, that is enough. This is page number 551. An entity has a profit from continuing operations, profit of 4,800, a loss from a discontinued operation of 7,200, and a total loss of 2,400. Okay, so if I were to find the basic EPS that I have to disclose from a continuing operation, from a discontinued operation, and from a total operation, my continuing operation would be a profit of 4,800 divided by the number of shares. This is 7,200 loss divided by the number of shares, and this is 2,400 loss again divided by the number of shares. Okay, and 2,000 ordinary shares. So for basic, you will just take the 2,000 ordinary shares. So this is 2.4, 2,000 ordinary shares. So this is, let us say, 3.6, but negative. Sir, can the EPS be negative? Well, why not? What is EPS? EPS is earning per share. You ask yourself, can there be a net loss for a company? Well, yes, net loss is the loss for all the shareholders. Well, EPS is the loss per shareholder. A lot of students believe that EPS cannot be negative. It has to be restricted to 0. That is wrong. EPS is nothing but the earning per share. So if your total earning can be negative, that is, you can show a net loss, your earning per share can definitely also be negative. And this is, let us say, 2,000, and hence this is a negative 1.2. Now, and there are 400 potential ordinary shares outstanding. Maybe there is no cost saving attached to that. There are just 400 potential shares. Okay. The entity's basic EPS is 2.4, which we have calculated for continuing operations, 3.6 negative for discontinued operations, and 1.2 negative for the total operation, for the total loss. Perfect. So there's nothing much over here. The question is, should the 400 potential shares be included in the diluted EPS calculation? Well, we will say, why not? Let us try to find, if we include the 400 potential shares, and what will happen? Well, your EPS from continuing operation, you will start where you will start the diluted EPS on where the basic EPS ends. So you will start at 4,800. There is no cost saving, divided by 2,000 plus 400, and as a result, this will be 2,400. So this is 2 rupees. If you compare 2.4 and 2, well, this is dilutive. It falls. When you look at discontinued operations, you will start at 7,200. Again, there is no cost saving, and you will take 2,400, which is a negative 3, which on the face of it, a student would say, we are going from 3.6 to 3, and hence it is a reduction, it is dilutive. That is wrong. Remember, whenever there is a loss, 3.6 is worst as compared to a negative 3. I'll again repeat, a loss of 3.6 is worse than the loss of 3. So if you include 400, what will happen is the loss per share is falling. The loss per share, which was actually 3.6, is now becoming 3, and hence it is a favorable, and hence this will be anti-dilutive. Similarly, if I look at the total operation, in the total operation, let us say you have a negative 2,400. If I also include the potential equity shares, this is divided by 400, and hence this is negative 1, which means there's a reduction of loss, and hence technically this is anti-dilutive, and this is the reason for the conflict. You have to report 3 EPS numbers. However, the inclusion of potential equity shares makes the EPS from continuing operations as a lower number. From 2.4 positive, it becomes 2 rupees, so that is a reduction. But the inclusion of into discontinued operations as well as total operations reduces the loss per share. So what do you do? Well, you will have 2 or 3 options in your mind. First of all, you would say, theek hai. So we will take 400 for continuing, but you will not take 400 for discontinued and total. That is wrong. Remember, your weighted average number of shares to be taken has to be the same across all the 3. You can't have a different number of shares if the operation is continuing and a different number of shares it is discontinued. So either you assume that 400 are going to be converted, or you assume it is not going to be converted because they are anti-dilutive. You can't take a mixture. So that is ruled out. Standard prohibits it, which means you have to take a decision based on whether we should consider them as dilutive because EPS from continuing operations is falling, or consider them anti-dilutive because total or discontinued is falling. So do we apply majority rule, majority wins or stuff? No, nothing like that. The standard pinpoints and identifies that out of the 3, which is the most important number. You guys think and tell me, according to you, out of these 3 numbers, EPS from continuing, discontinued and total, which is the most important? Well, almost everyone is clear that discontinued is not as important. It's either the total or the continuing. As per Ind AS, it is continuing operations. It treats this number over here as what you call as a control number. It says that for an investor, the most important number is how much has been earned from the continuing operations, because that is going to continue. Yes, as a matter of fact, in the current year there might have been discontinued operations, but going forward that is not going to happen. And hence the most important number is the EPS from continuing operations, which is also called as a control number. So if your EPS from continuing operations is falling, then these 400 shares are treated to be dilutive, and hence these 400 have to be included in all the three calculations. These 400 have to be included in all the three calculations. Acha. However, if this was the other way around, where the discontinued operations gave you a profit of 4,800 and the continuing operations had a loss of 7,200, in which case 7,200 divided by, let us say, 2,000, your EPS from continuing operations would have been a negative 3.6, which is becoming a negative 3, and hence you would say the inclusion of 400 reduces the loss per share, and hence it is anti-dilutive, in which case the 400 will not be included in all the three cases. So we are not going to take the majority or minority. We are going to look at, if we have to decide whether a particular potential equity share is dilutive or not, we will look at whether the inclusion of that potential share reduces the EPS from continuing operations. If it does, then it is dilutive. If it does not, it is anti-dilutive. So over here, if you were to calculate diluted EPS, the diluted EPS over here for all the three would actually be 2, a negative 3 and negative 1, because you will include 400 for all the three. So as you can see, 2, negative 3 and negative 1. Acha, we'll read the theory for this and then also go to the one question on these lines, which is there, I think, on question number 18. So let us go through the theory on page 72. The basic and diluted EPS needs to be presented on the face of the income statement. ठीक है, वो present कर लेंगे. Further, we need to show the EPS from continuing, discontinued, as well as total operations separately. I'll show that to you even the schedule 3. In determination of whether the potential shares are dilutive or anti-dilutive, we should look at the impact of the EPS from continuing operations, which is also called as the control number. In case the EPS from continuing operations gets diluted, that is, it gets reduced. In case the EPS from continuing operations gets diluted on the inclusion of potential shares, then these potential shares should be included in the EPS from discontinued operations and total operations, which is irrespective of whether the diluted EPS falls or not. We will take the decision based on the control number, which is the EPS from continuing operations. Achha, look at question number 18, please, in your volume number 1, standard, page number 127. Let us go to question number 18. Assume the following facts for company XY. Okay, income from continuing operations is 30 lakhs, loss from discontinued operations is 36 lakhs, and hence your net loss is 6 lakhs. The weighted number of shares outstanding is 10 lakhs. So over here, if you were to calculate the basic EPS, it's fairly easy, divided by 10 lakhs. So this is 3 positive, this is 3.6 negative, and hence on a totality basis, this is 0.6 negative. Okay. Incremental common shares outstanding relating to stock options. This is incremental. Incremental means additional only. So this is like the free element directly given to you. It's like the incremental shares outstanding relating to stock options. 2 lakhs. So the question arises, should you include this 2 lakhs or not? Well, what we will do is, among other things, we will try to calculate whether the inclusion of this 2 lakhs, whether it dilutes the EPS from continuing operations, which is going to be 30 lakhs divided by 10 plus 2, this is 12 lakhs. 30 lakhs upon 12 lakhs, which is equal to 2.5. So this is equal to 2.5. Achha, your basic EPS is 3 rupees. And if I include the 2 lakh shares, it becomes 2.5, and hence the inclusion of this 2 lakh shares reduces or dilutes my EPS, and hence these 2 lakhs are dilutive. and if they are dilutive, they have to be included for all. So even if I look at EPS from discontinued operations, this is 36 lakhs negative divided by 12, and hence this is a negative 3. Apparently it is a reduction of loss, but still you will take it. This is a negative 0.6 again divided by 12. So I think this is a negative 0.6 divided by 12, which comes to, or let's say 6 divided by 12, 6 lakhs. So this is a negative 0.5. Your loss per share falls, still you will take it because the EPS from your continuing operations is diluting. So this is 30 divided by 12, and hence this is equal to 2.5. Perfect. So this is sub point A. You are required to calculate the basic as well as the diluted EPS of company XY from the above information which we have. Second, assume in the above case the loss from continuing operations is 10 lakhs and the income from discontinued operation is 30 lakhs. Acha. Then you are supposed to calculate the EPS. So over here you will have loss from the continuing operations, income from the discontinued operations, and hence your total operations. So if I look at the basic EPS working, this is a negative 10 upon 10 lakhs, and hence this is a negative 1. This is basic EPS. This is 36 lakhs positive upon 10, which gives you 3.6. This is 26 lakhs net positive divided by 10, which gives you 2.6. Acha, now if I want to find the EPS from continuing operations on inclusion of that 2 lakhs, this is 10 lakhs upon, this is negative, upon 12 lakhs. And as a result, this becomes a negative 0.833, which means this is anti-dilutive. It reduces the loss per share. And since it is anti-dilutive, the 2 lakhs should not be included. And hence your diluted EPS is also a negative 1, 3.6 and 2.6, irrespective of whether it would have diluted the discontinued and total operations or not. Okay, so that takes care of question number 18. 19, 20. So ek kaam karte hai, sabhi, they are fairly interesting, so you can mark them as important. So 12 ke baad you will have, let's say 17 you have marked, 18, 19, 20. 19 and 20 are fairly complicated. Aja. One is on the concept of what you call as contingent shares, that is question number 19, and 20 is on the concept of group EPS. So both of these are fairly complicated. So again, we have not done consolidation, but rather than waiting for completing consolidation, we can just try to apply the basic concepts and try to find the group EPS. So this is question number 20, where there is financials given about a parent, then financials given about a subsidiary, and then you have been told to calculate the group EPS. So what is group EPS? Group is a consolidated EPS where in the numerator you should take the consolidated profit and in the denominator you should take the shares. Now the question arises, whose shares? As we have discussed in question number 16, in your consolidated balance sheet, and even if you open any of your inter-CA books, or once you will do consolidation, you will find that in the consolidated balance sheet, the share capital is always the share capital of only the parent. Subsidiary share capital does not enter into the consolidated balance sheet. So when you calculate the group EPS, in the denominator you have to remember that you will only have the shares of the parent. Even if there are any potential equity shares issued by the parent, that will be taken in the denominator. If it is issued by the subsidiary, that does not come in the denominator. So we will keep that in mind and try to find the group EPS. Now group EPS on a basic level is relatively manageable, but group EPS on a diluted basis is a little complicated. So we'll read question 20 and using the numbers and applying the concepts, we will try to solve. So let us go to the second last question, question number 20, which is also an important question. Achha, calculate the subsidiaries and the groups basic and diluted EPS. So this is to be calculated for the subsidiary as well as for the group as a whole. Only parent's EPS is not asked. If you want, you can even calculate that. Achha, parent profit attributable to ordinary equity holders of the parent. You'll have to add a couple of things over here. So this is into bracket before, या फिर चलो ठीक है added ही है 12,000. This is excluding any earnings of or dividends paid by the subsidiary. So here in this 12,000, you have not booked any income from the subsidiary. Subsidiary can give you dividend in the form of equity dividend if you are holding equity shares in the subsidiary, or preference dividend if you are holding preference shares in the subsidiary. This 12,000 is before considering that. Okay. Ordinary shares outstanding are 10,000, and instruments of the subsidiary which are owned by the parent. Instruments of the subsidiary owned by the parent are, you have 800 ordinary shares of the subsidiary owned by the parent, 30 warrants exercisable to purchase ordinary shares of the subsidiary also owned by the parent, and 300 convertible preference shares. Satyanash. Subsidiary has issued probably equity shares, it has also issued warrants, it has also issued convertible preference shares, and unfortunately for you, you are holding all the three. Okay. The subsidiary has a profit into bracket write down before deducting preference dividend. Write this down. You'll have to add two things over here. One is this profit, which is before deducting preference dividend, is 5,400. The ordinary shares outstanding are 1,000, and the warrants are 150. Exercisable to purchase ordinary shares of the subsidiary. Just to be clear, 800 shares are held by the parent. So this is parents holding in the subsidiary. Out of a total, if you go to see subsidiary mein, how many shares are there? Well, total there are 1,000 shares. So this is 1,000 total in the subsidiary. How many warrants are there? Well, 150 warrants. Okay. The exercise price is 10. The average market price of one ordinary share is rupees 20. Okay. The average market price is given as 20. Fair enough. The convertible preference shares. The convertible preference shares are 400. Okay, we are probably holding 300 out of that, but the total is 400. Convertible into one ordinary share, and the dividends on the preference shares is rupees 1 per share. No intercompany eliminations or adjustments were necessary except that for dividend. So whenever dividend is there, you will have to probably do an elimination for dividend if required. But otherwise, there are no other intercompany eliminations needed. You are supposed to ignore income taxes. Thank you. Also ignore the classification of components of convertible financial instruments as liabilities and equity, or the classification of related interest as expenses or equity as required by IND AS 32, which effectively means that you are supposed to ignore the application of IND AS 32, that is financial instruments, and solve as if you were solving a standard accounting standard question where you don't split the convertible preference shares between liability and equity. You don't really think that the preference share is classified as a liability. You don't think that preference share should be an equity. Whenever this point is given, it treats that you have not studied anything about IND AS 32 or 107 or 109. Which means preference shares are treated like owners and payments to preference shares are treated as an appropriation. For example, you don't treat it as a liability, you don't treat compound financial instruments. All of these new things that you had studied in IND AS 109 are to be ignored if such a paragraph is given. Even if it was not given, we would have assumed that over here because you don't have a market rate of interest on similar non-convertible instruments. Add one more line. Assume all potential equity shares are dilutive. Assume all potential equity shares are dilutive, and hence a direct calculation taking all potential shares, taking all potential equity shares can be done. So we don't have to worry about the order, the ranking, the incremental EPS, not required. Pause the video, and definitely read this question again, something which is completely new. Okay, so there are two things which are asked over here. First is to calculate the basic EPS for the subsidiary and the diluted EPS for the subsidiary, which is slightly easy. The group EPS is something which is new. Subsidiary is still a single entity. Whether it was subsidiary of a company or not, how does it matter? If you have to calculate the EPS for the subsidiary, you will do it in the usual manner. So we will try to find the basic EPS for the subsidiary. ये इसके ऊपर का सभी चीज parent है. This is where subsidiary starts. So when we look at subsidiary, the profit that the subsidiary has earned, which is before preference dividend. Ideally, preference dividend could have been taken into, let us say, finance cost, or it can be retained earnings. It is convertible, so you'll have to have a liability component. कुछ भी वो सब नहीं करना. Ind AS 32 has to be ignored. The question clearly tells you, you ignore the classification. As per Ind AS 32, you even ignore the accounting that some of them should be expenses, some of them should go to equity. Nothing is to be done, and hence we have clarified and said it is before preference dividend. But even if we had not clarified, we can still take this 5,400 to be before preference dividend. That is, we are ignoring the 109 concepts. Okay, so the profit over here is for 5,400, but unlike what was given over here, which was profit attributable to ordinary shareholders, here it is profit which is not necessarily attributable to ordinary shareholders. You will have 5,400 rupees. You will have 5,400 rupees. Okay. However, this is the total profit, out of which you will have to pay nothing to the option holders, but you will have to pay 1 rupee per share to the preference shareholders. So this is 5,400 minus, let us say, 400 into rupees 1. 400 into rupees 1. And as a result, this is 5,400 minus 400 divided by the number of shares. Acha, number of ordinary shares that are there in the subsidiary, which is, I think, 1,000. So this is divided by 1,000, and as a result, this is 5,400 minus 400, which is 5,000 rupees, upon 1,000. So your basic EPS is rupees 5. What does this mean? For every one actual equity share held in subsidiary, colon, earning is rupees 5. For every one actual share held in the subsidiary, earning is rupees 5. Just for your knowledge, parent is holding how many equity shares in the subsidiary? Well, parent is holding 800 actual equity shares in the subsidiary, and for each equity share the earning is rupees 5, and hence for the total 800 shares the earning should be 800 into rupees 5. This is rupees 4,000. This is just done for your reference right now. We may need to use this later, though this was not as such required. It is just that it builds up your understanding. Achha, then comes a slightly tricky part where you calculate the diluted EPS again for the subsidiary. Now diluted EPS will be calculated after considering all the potential equity shares. There are multiple potential equity shares over here, and we have considered that these multiple potential equity shares are all dilutive. This is given in the question. We have added this. Achha. However, in case of options, we will only have to add the incremental element or the free element. So in case of options, we are saying that the subsidiary has issued 150 warrants which are exercisable to purchase ordinary shares of the company unless given otherwise. This 150 warrants will convert into 150 ordinary shares, and hence if these options were exercised, 150 ordinary shares will be issued. However, if 150 ordinary shares are issued, then the company will receive 150 into rupees 10 in the pocket, which means 1,500 rupees will flow. But what will you do with this 1,500? Probably we will use this money to buy back our own equity shares. But when you go to buy back your own equity shares, you will have to pay rupees 20. So this is 150 minus 1,500 upon 20, which is 75. And hence, you can issue 150 shares, get 1,500, use that 1,500 to buy back 75 shares, but at the at the end of it, there is still 75 incremental shares which will still remain, which are your potential equity shares. Okay. Now, if I were to calculate the diluted EPS, the diluted EPS will start where the basic EPS ends. The basic EPS ends at 5,000. So the diluted EPS starts at 5,000 divided by 1,000 ordinary shares. Achha, what are the potential equity shares? There are two potential equity shares. One is the convertible preference shares and one is the options. Achha, if options are converted, well, there is no real cost saving. There's no fair value gain or loss which is also given. So there's no real cost saving. So this is added 0. And in the denominator, you will add the incremental or the free element. Achha, when the convertible preference shares are converted, you will save paying this 400 into rupees 1 of dividend. Had these been converted at the start of the year, you did not have to pay 400 into rupees 1. Achha, but then these, if preference shares are converted, they will also get converted into equity shares. So 400 each convertible into 1 ordinary share. So this is 400 preference shares will become 400 into 1, that is 400 ordinary shares, which means this is rupees 5,400 divided by 1475, and hence this comes to, or let us say we take it over here, 5,400 divided by 1475, which comes to I think 3.66. Now what does this 3.66 indicate? Understand this very carefully. It indicates that for every one actual slash potential equity share held in the subsidiary, colon, the diluted earnings per share is rupees 3.66. Achha, now if we want to build our understanding, how many actual slash potential shares is the parent holding out of 1475? Achha, 1475 includes, 1475 mind you includes 1000 ordinary shares, out of which 800 are held by the parent. It includes 75 incremental shares, does not include the entire 150. Does not include the entire 150, it includes only the 75 incremental shares pertaining to warrants, out of which apparently 30 is held. However, 30, remember, the parent holds out of 150. We have not taken 150 in 1475. We have taken only 75, and hence we can't even take the full 30 over here. We'll have to do some workings. And preference shares are 400, out of which the parent owns 300. So what are we trying to come to, sir? Well, we are trying to say that if I want to find the attribution to the parent, this is out of 1475 actual slash potential shares. We can say that ordinary shares are 800, preference shares are 300. Achha, just for your reference, the total over here in the subsidiary is 1000, out of which 800 are attributable to the parent. The total is 400, out of which 300 is attributable to the parent, and the total over here is 75. And that is when we say that, okay, out of the total 1475 that is taken in the denominator, the earning is 3.66. But we take 75, and hence we have to say, I mean, you can cross multiply, but you can say that you will have to find the incremental or the free element of 30. We will say that chalo 30 hai, so 30 into rupees 10 upon rupees 20, if you do, equals to 15. So this equals to, let us say 15. And hence one can say that, well, out of 150 warrants, we are including 75 in the potential shares calculation. So out of 30 warrants held by the parent, you would have included 15. So what I'm trying to say is, well, what is 30 is included in 150, then in 75 how much is included? You can even do this cross multiplication and come to 15, and hence we can say that chalo theek hai, 30 was included within 150, but 150 is not included in 1475, it is only 75 which is included in 1475. Then out of 75 how much is attributable to the parent? Well, it is 15, not 30. 30 is out of 150. Then out of 75 how much? So this will be warrants. So this is potential / actual equity shares. Acha, so this is held by the parent. Let me take this over here. Acha, for each share, whether it is actual or potential, within 1475, the earning is 3.66, and hence you will take into 3.66 for each of them to find the total diluted earnings from which the parent earns from the subsidiaries instruments. So over here this is 800 into 3.66, which will be 2928. 300, sir, 300 किधर actual share है? Actual share नहीं, but it is potential share. When you calculate 3.66, we are saying 3.66 is the earning per each instrument included in 1475. 1475 में 1000 भी included, which are ordinary shares. 1475 में 400 will be included, which are preference shares. So each of these 400 shares are also earning 3.66. So basically, if you go to see 1475 into 3.66 will give you 1475 into 3.66 will give you 5400. So we are saying this 5400 is to be shared between all the actual / potential shareholders pro rata, in which case if I am holding 300 preference shares, then these 300 preference shares into 3.66 is going to come to 1098. And lastly, 3.66 into, we are holding 30 warrants, but well, in our total working 1475 we took 75, and hence proportionately instead of 30 we will have to take 15. So this is 15 into 3.66, and hence this is 54.9. So if I total this up, we can say that the parent's attribution to the diluted earnings in the subsidiary is 2928 plus 1098 plus 54.9, which is 4080.9. 4080.9. Okay, so this was not required now, sir. Then why are we doing? Well, because the question also asks you to calculate the group EPS. Acha, when it asks you to calculate the group EPS, first you try to find the basic EPS. Acha, basic EPS में क्या रहेगा? सबसे पहले in the numerator you will have to take the profit attributable to the parent and then divided by the number of shares. अब ये shares किसके होने चाहिए? Well, these are shares of the parent only. Parent has 10,000 shares, and hence these are shares of the parent only. So denominator will be 10,000 only. In the numerator, what will be taken? So we are going to say that the consolidated profit is definitely going to include the parent's own profit. Let's say Reliance Industries is the parent, Reliance Jio is a subsidiary. So when I look at the profit on a consolidated level, it will definitely include this 12,000, which the parent has itself earned had there been no subsidiary. This is excluding any earnings of or any dividends paid by the subsidiary. So this is purely parent's own earnings. So this is parent's own earning. Apart from that, the parent is also earning certain instruments in the subsidiary. Like it is earning 30 warrants. We are not taking free element or anything. It is earning, it is holding 30 warrants, against which have you received any earnings? No. So against these 30 warrants on an actual basis, har ek ka apan actual lege, on an actual basis you have received nothing. This is not diluted basis. This is not a hypothetical basis. On an actual basis we are holding 30, but you are getting nothing. Okay. Plus we are also owning 300 preference shares. On an actual basis we have received 1 rupee. This is basic EPS. We are not doing a diluted calculation. We are doing basic, and I'm holding 300 actual preference shares in the subsidiary. In each of these preference shares, let us say, gives me 1 rupee. Apart from that, I'm also owning 800. I'm also owning 800 equity shares in the subsidiary. These equity shares have not actually given me any cash inflow. However, so in my standalone basis, if I have to prepare my SFS, in my standalone, not group EPS, if I have to prepare standalone EPS of the parent in the standalone financial statements, I will say 80 के ऊपर भी कुछ भी नहीं मिला मेरे को, 0. However, when I look at the group EPS, IND 110 tells you that consolidation has to happen and the subsidiary's profits will be consolidated with the parent. Acha, a part of those profits are attributable to the NCI. That is for those 200 shares which are not held by the parent. It is attributable to NCI. वो तो हम नहीं consider कर रहे, but the remaining is attributable to the parent. So the subsidiary might have earned a profit of 5,000 rupees, let us say, but out of that 5,000, 20% is attributable to NCI, that is 1,000. However, the remaining 4,000 will be consolidated with the parent in the group EPS, in the consolidated balance sheet, in the consolidated profit and loss account. I will not just look at my profit and loss. Yes, I will look at the profit and loss account of Reliance Industries, but I will also look at my share in the profit of Reliance Jio and consolidate it with me. So in my group EPS, I will multiply this by rupees 5, because 4,000 of profit of the subsidiary will be consolidated. 5,000 is the profit of the subsidiary, as you can see over here. Out of this 5,000 profit attributable to subsidiary shareholders, 20% is held by someone else, which we are not taking, but the remaining 80% is held by us, which has to be consolidated. Even if no dividend is paid, this is consolidated, and as a result over here, this is, let's say, 12,000 plus 0 plus 300 plus 4,000. So this is, let us say, 16,300. Parent has not issued any potential instrument. Subsidiary has, but in the denominator you only take the parent's shares, and hence this is rupees 1.63 if I'm not wrong. Perfect. Achha, if I were to calculate the parent's standalone EPS, yes, 12,000 रहता था plus 0 plus 300 plus यहाँ पे 800 into 0 आएगा, because you have not received any dividend from the subsidiary. Had you received dividend, actual dividend, then my standalone books that appears as dividend income, I would have taken it. I'm doing consolidated EPS, and because I'm doing consolidated EPS, I'm joining parent and subsidiary together. Acha, this is your basic EPS. Then comes diluted EPS. Acha, when we look at diluted EPS, parent does not have any potential equity shares, so 12,000 actual earnings for the parent is equal to the diluted earnings for the parent. However, the subsidiary has dilutive instruments, and if I assume a dilution is to happen, parent में denominator में कोई potential equity share है ही नहीं, but if I assume a dilution is to happen, then each instrument, whether it is actual or it is potential, that the parent owns in the subsidiary, for each instrument, how much will the parent get? Well, here I'm not looking at the actual instruments, I'm looking at the potential instruments. So your potential, PES, potential equity shares in case of warrants are 15, and for each of these 15 instruments, rupees 3.66. 3.66 is earned on 1475, and 1475 के अंदर 15 included. Plus, well, the potential equity shares that you are holding in the form of convertible preference shares is actually 300. Well, each preference share may give you an actual dividend of 1 rupee, but now we are not looking at what the actual dividend, we are looking at what potential equity share is getting. Potential equity share 3.66. Parent is holding not just 800 ordinary shares, parent is also holding some potential shares, and as a result, यहाँ पे plus you will take 800, but this 800 is also to be multiplied by 3.66. We are doing the diluted calculation, so हर एक instrument, it is not that in that 1475,000 is going to earn 5 and the remaining 475 is going to earn 3.66. No, each of the instrument within the 1475 is earning 3.66. So over here, this is If I total up, this is 12,000 plus we have, I think, done this working earlier. This is 4080.9. You can again do it over here as well, divided by 10,000. So this is, I guess this is 16,000. 080.9 upon 10,000, and as a result, this is what the institute has done. There may be some controversy in this. Some students might say, why are we taking 3.66? Well, according to me, this is done correctly, but nevertheless, you can have an alternative view. But in any case, this is one and the only question based on which this is done, so we should solve by in these lines only. So this is, I guess, 1.608, which is lower than the basic, and hence this can be treated as diluted. So this is one and the only question on these lines. It has never come in the exam, but if it comes, you should be aware that this is how you solve it. Okay, so that takes care of question 20, and then you go to the last question and also the last concept of this chapter, which is on contingent shares. Now, what do you mean by contingent shares? As the name goes, these are shares which are contingently issuable, which means on happening of certain events, you might have to issue the shares. On the non-happening of certain events, you may not issue such a share. So, sir, how will such an instrument come into existence, and what are the examples? One of the best examples of a contingently issuable share is what arises at the stage of business combination. So, for example, there is Facebook and it is acquiring, let us say, your favorite WhatsApp. In which case, let us say the Facebook and WhatsApp, there's a difference in valuation. WhatsApp owner said that my company is worth X billion. Facebook says no, Y billion. Why? WhatsApp expects phenomenal growth in user base. Facebook is not agreeing with that. So what they might issue is, apart from a fixed consideration, they might agree to what you call as contingent consideration, and you will study this in the chapter of business combination. So when you look at contingent consideration, Facebook might say, for example, that if your user base after, let us say 3 years is less than 100 million, or between, let us say, 100 and 200 million, or greater than 200 million, depending on your user base, I will issue shares. So over here, shares to be issued. Shares to be issued, let's say after 3 years. You will issue these shares also after 3 years only. But the shares to be issued are, let us say, if the additional shares, maybe existing, like actually Facebook had acquired WhatsApp for around $15 billion, and there was a contingent consideration of around $3 to $4 billion more. So let us say we have said that we'll issue 0 shares. Over here, if this happens, we'll issue 100 shares, and if this happens, we'll issue 200 shares, for example. Apart from that, your PAT of Facebook, let us say, PAT of the parent entity in years 1, 2, 3 and 4, let us say, are given to you as, let us say, 1,000, 1,100, 1,200 and 1,300, for example. Apart from that, your actual shares which are outstanding, are, let us say, 100, 100 and 100, for example. Now if I have to calculate the basic EPS for year 1, in year 1, is the contingent share agreement in place? Is the contingent consideration in existence? The answer is yes, it is in existence. However, have the shares actually been issued, or have they become issuable? The answer is no. And as a result, in your basic EPS calculation, your basic EPS will be done based on the actual shares. And over here, your actual shares, till the time the 3rd year is over, we will not know what the user base is. And as a result, in the basic EPS calculation, you will ignore these contingent shares till the time they are actually issued or they become issuable. So for example, this becomes 10, this becomes, let's say, 11, this becomes, let us say, 12. However, when you look at diluted EPS, so over here, what can happen is your actual user base. Now, one can always argue that let us take the expected users and then forecast. The standard says no, we need an actual data, not a forecast. And hence the standard says that for the diluted EPS calculation, you will do the working considering the fact that if your let's put it this way, if your contingency were to end in year 1, let us say your actual user base, let us say you were given that the actual users at the end of year 1, at the end of year 2, at the end of year 3, and at the end of year 4. Let's say the actual users over here are, let's say, 130. In the second year, the actual users go down to, let us say, 80. In the third year, they become, let us say, 230, and then it again comes down to 160, for example. So what does the standard say? For the contingent shares in the diluted EPS calculation, basic EPS, you will include them only when the shares become actually issuable. But for the diluted EPS calculation, you will include them in the diluted EPS calculation considering the current period to be the end of the contingency period. If the current period were, let's say, if year 1 were to be the end of contingency, then the potential shares that are to be issued would be, let us say, 100. If year 2 is the end of contingency, the potential shares that are to be issued is 0. If year 3 is the end of the contingency, which by the way it is, then the actual shares that are issued are 200. In year 4, it does not really matter. The contingency ends, as a matter of fact, in year 4, and hence 200 shares are additionally going to be issued, but they will be issued at the end of year 3. So the earliest day you can take them in the basic EPS calculation is the start of year 4. So when you go to year 4, your total will be 100 plus 200. We can actually see that 200 shares additionally would be issued, but that is at the end of year 3 or the start of year 4, and hence this will go in the basic EPS calculation only of year 4. So this is 1300 divided by, let us say, 300, and hence the basic EPS now becomes 4.33, for example. But if I were to mentally prepare the shareholders for such an eventuality, then you will do the diluted EPS calculation. You don't have to pay anything to these contingent shares, and as a result, there's no cost saving as such. But in year 1, if I were to calculate the diluted EPS, you will take the 1000 profit in the numerator. In the denominator, you will take 100 plus, if the current period were to be the end of contingency, then another 100 would be issuable, in which case this would be rupees 5. When it goes to year 2, if year 2 were to be the end of contingency, it is not, then no shares are issuable, in which case you will take this as 0, and hence this will be, let us say, 11. So do we need to restate the last year's numbers? The answer is no, sir. Why not? Because this is not a change in accounting policy. This is not even an error which is mathematical. This is something which is a matter of fact or a matter of judgment, and hence in the last year you felt that 100 shares would be ultimately issued. Now you believe 0 shares would be ultimately issued. That is, if the current position continues till the end of the contingency period. So year 1 is not the end of contingency period, but if the position continued till the end of the contingency period, then there would be let's say 130 users. Based on that, you will have to issue 100 shares. But if you go to the end of the second year, the users are 80, and if we assume that this is the current situation which will continue till the end of contingency, then 0 shares are issuable. But when you go to the third year, the profit is 1200, but in the denominator you will take 100 plus your 200 are potential for the entire year. They will become actual from the start of the next year or the last day of the year, but they are potential for the entire year. This is 200. If the current period were to be the end of the contingency, then throughout the entire year, 200 shares are potential. They will become issuable at the end of the year or start of the next year, but they are potential, and hence 1200 upon 1200, 1200 upon 300, which will come to, let us say, 4 rupees. And then when you go to year 4, you will have 1300 upon, let us say, 300, which is actual, plus now nothing is potential, and hence this is the same 4.33. Are we clear with this? Long story short, in case of potential equity shares, which are contingently issuable, for basic EPS calculation, you will include them on an actual basis only once the contingency conditions are actually fulfilled and the shares become issuable. That is over here at the end of year 3 or start of year 4. But for diluted EPS calculation, since a contingency agreement has been signed, these instruments are potential, but how many of them are potential, we don't know, and hence we assume that if the current period were to be the end of contingency, the same situation continues till the end of the contingency, then how many shares are issuable? Jitne bhi aapne determine kiye, you will consider them to be potential for the entire period. Basically, that is from the date of the contingency agreement or the start of the year, whichever is later. So if the contingency agreement has already been incurred, then the agreement is in existence for the entire year, and hence they can be potential for the entire year. Acha, based on that, you will read the theory once and then go to the numerical. So we will go to page number 73. There is a chart on contingent shares. Let us go through that chart. So there are two possibilities. There is basic and diluted. Achha, basic EPS says shares should be included in veins from the date the conditions are actually fulfilled. That is, the shares become actually issuable. Whereas in case of diluted EPS, you have been told that shares should be included in the current year as potential shares only if the shares are issuable, considering the current period to be the end of the contingency period. Like in year 1, you included 100. Potential shares are to be included from the beginning or from the date of the contingent share agreement or the beginning of the year, whichever is earlier, because from the date the contingent agreement is signed, they become potential. Prior period restatement is not needed. Like in year 2, you say that abhi 0 hai. That does not mean in the previous year column you also consider this to be 0. No, in the previous year column this will continue to be based on 100 only, because that is based on an estimate which was done in the last year, which was correctly incorporated. There is no error and hence requires no retrospective restatement. Acha, we will go to question number 19, the only question on these lines. It's an important question again. It's as such a manageable question, but अपन यहाँ पे उसमें एक और twist add करेंगे, which will make it a little more complex. Okay, let us read this properly. Question number 19, the last question for this standard. Acha, the ordinary shares outstanding during 2011 is 10 lakhs. There were no options, warrants or other convertible instruments outstanding during the year. So there are no other potential equity shares. An agreement relating to a recent business combination. So combination has already been done. So this business combination has already been done in the past. Provides for the issue of additional ordinary shares based on the following conditions. Okay. First, so we'll just give the headings for these so that it is easier for us to address. So there is something called as retail contingency, and then there is something called as earnings contingency. Acha, what is then retail contingency? You have been told that 5,000 additional shares for each new site, like a store, opened during 2011. So during the year, jitne bhi naye sites khule, against that 5,000 shares are issuable to the owners of the selling company. And earnings contingency, 1,000 additional ordinary shares for each rupees 1,000 of consolidated profit in excess of rupees 20 lakhs for the entire year ended 31st December 11. Again, 1,000 additional ordinary shares for each rupees 1,000 of consolidated profit in excess of rupees 20 lakhs for the year ended 31st December 11. So for example, the profit for the year 2011, that is the current year, this is let's say this profit comes to 30 lakhs, which means 10 lakhs is in excess of rupees 20 lakhs. Then for this 10 lakh rupees, against this 10 lakh rupees, for every rupees 1,000 of the profit in excess, you are going to issue 1,000 shares. And as a result, 10 lakhs upon 1,000 into 1,000, you will issue 10 lakh shares. But these 10 lakh shares will become issuable. They will actually become issuable once the profit for the year is determined, not before that. Sir, but the moment it crosses 10-20 lakhs, we will consider, no, for all you know, there might be losses also. So let us say in the first half year, your profit is 30 lakhs. So we are saying, that means 10 lakh shares have to be actually issued. No. You might be running a seasonal business and your peak season may be the first half of the year. You might have a slow season in the second half of the year, in which case there might be a loss of 15 lakhs, in which case the profit for the entire year is only 15 lakhs, nothing is issuable. The shares will become issuable not when you cross 20 lakhs. Shares will become issuable when the profit for the year 2011 crosses 20 lakhs. Acha. So they will become issuable, let us say, from 1st of January 2012, provided the profit has crossed 20 lakhs. Acha, and the retail contingency is not linked to the end of the year. It is linked to opening of the new store. So the moment a new store is opened, 5,000 shares become issuable. Okay. The retail sites opened during the year. One of the sites is opened in May, and then one of the sites is opened in September. Okay. यहाँ पे आना चाहिए consolidated year to date profit which is attributable to ordinary shareholders of the parent entity. This is consolidated year to date profit, which is 11 lakhs as on 31st March 11. This is year to date, which means this is 1st January 11 to 31st March 11. 23 lakhs as on 30th June 11. So it's a year to date profit, not the quarterly profit. So this is 1st January 11 to 30th of June 11. 19 lakhs as on 30th September. The profit is going down. Probably there is a loss in the coming quarter, including 4,50,000 loss from a discontinued operation. Okay. So over here, this is, let us say, 1st January 11 to 30th of September 11, and 29 lakhs as on 30th December. So this is 1st January 11 to 31st December 11. Calculate basic and diluted EPS. Just add a thing from total operations. From total operations. Just pause the video and read it again once. Acha, when we go to question number 19, then for the year 2011, if I were to calculate basic EPS would be based on actual shares issued. So your profit for the entire year, this is the year 2011, is rupees 29 lakhs. Beech mein kuch, it's not quarterly profit, it is year to date profit. And hence, the profit for the entire year is 29 lakhs. Upon, in the denominator, you had 10 lakh shares which were issued and outstanding for the entire year. However, during the year, on account of retail contingency, have there been any shares which have actually been issued? Acha, let us say the retail sites opened are one on May and one in September, which means the moment the retail site is opened, the share becomes issuable and hence it should be a part of the basic EPS, which means 5,000 shares will become issuable from 1st of May, which means the number of months they would remain outstanding is May, June, then July up to December. So that is a total of 8 months out of 12 months. Achha, is that it? Well, apart from that, another 5,000 shares become issuable when you open another store in September, which means these shares will actually be outstanding in the month of September, October, November, December, 4 months. Achha, now comes a slightly debatable point where, what about the earning contingency? Is the earning contingency fulfilled? The answer is yes. Achha, when is it fulfilled? At the very last day, at the stroke of midnight of 31st December 2011. Technically, that is when it is fulfilled. That is when you will know कि अच्छा इसके next second पे भी अगर loss होता है, that will go in the year 2012, not in the year 2011. And as a result, the profit for the year will actually be fully determined as on 31st December 11. Yes, in practice you will calculate it and you will know about that in the next year, but the accrual ends on 31st December 2011. And as a result, we will say that, well, as per the earnings contingency, the profits for the year 2011 are 29 lakhs. Achha, are they in excess of 20 lakhs? Well, yes. How much excess? Well, 9 lakhs. And hence, for every 1,000 that is there in excess, 1,000 shares are issued. And as a result, this is going to be 29 minus 20. So this is 9 lakhs upon 1,000 into 1,000, which comes to 9 lakh shares. Achha, but these shares will become issuable on 1st January 2012. Actually, on an actual basis, they will become issuable on 1st of January 2012, not on 1st January 11. They may be potential for the entire year, but not actual. And as a result, they will not be taken in the basic EPS calculation because they are not issuable. Throughout the entire year, like 5,000 shares become issuable on 1st of May. You're not taking it from the very first day of the year, you're taking it from 1st of May. In a similar way, these shares become issuable at the stroke of midnight of 31st December 11, that is, for all practical purposes, from 1st of January 2012. And hence, nothing is actually issuable in the current year on an actual basis. And hence, if we do this calculation, this is rupees 29 lakhs, which comes in the numerator. Rupees 29 lakhs, which comes in the numerator, divided by, you will have, I guess, if we do this working, you will get 10 lakh 5,000. And hence your basic EPS is 2.89 for the entire year. This is rupees 2.89. Achha, now if I want to calculate the diluted EPS, the diluted EPS over here will be calculated considering the potential equity shares. Achha, if I look at the diluted EPS for the entire year 2011, in the numerator you will have 29 lakhs, but you have to ask yourself that are there any shares which were potential in nature, where you will start where the basic EPS ends, that is 10 lakh 5,000, in which case the 5,000 that are issued from 1st May or 1st September have been taken, but are there any potential shares? So if I look at the potential shares for the retail contingency, the first 5,000 shares are actual from 1st May to 31st December. However, for the first 4 months, they will remain potential because a contingency agreement has been signed. So they are potentially issuable. And if the current period were to be the end of the contingency period, then these 5,000 shares are issuable, and technically they are issuable from 1st of January, that is the very first day. However, as a matter of fact, they were issued on 1st of May. However, they are issuable from 1st of January, and hence they are potential for the first 4 months. Similarly, the second 5,000 shares which were actually issued on 1st of September will remain actual for the last 4 months. However, if the current period were to be the end of contingency, which it is, then these shares are to be included in the diluted EPS calculation, but then they have to be issued from the very start of the year, because these shares were potential. They actually were issued when the contingency condition was met, but they were potential because the agreement was signed. And hence they were potential not for the entire year, they were potential for the first 8 months. They became actual after that, but for the first 8 months, that is 1st January to probably 31st of August, they remained a potential. And then 9 lakh shares, which is attributable to the earnings contingency, were not actually issued during the year. However, since the agreement was in place for the entire year, there was a possibility that you would end up issuing such number of shares, and hence they remain potential for the entire 12 months. If you found this, you can do the workings by giving these weights for the potential period. So this is 5,000 into 4 by 12 plus another 5,000 into, let us say, 8 by 12 plus 9 lakhs into 12 by 12. Achha, we are just doing this for total operations. We are ignoring the continuing and discontinued operations as we have been instructed in the question. We have added that. So this is 29 lakhs upon, let's say this is 10 lakh. So this is, I think, 19 lakh 10,000. And hence your number comes to 29 lakhs upon 19 lakh 10,000, which is 1.51, which I guess 1.518, which is lower than the basic, and since it is lower than the basic, which is 2.89, we can count this to be the diluted EPS as well. So the question technically ends over here. Remember that shares are potential from the start of the year or the date of the contingency agreement, whichever is later. Contingency agreement is of a business combination which has already been done, and hence it must have been entered even prior to 2011. So these shares, the contingency agreement was in existence on the very first day. So these shares were potential from the very first day. Actually issue nahi hue, but diluted EPS is based on potential, right? So they were potential for the entire year. Achha, so your solution technically ends over here. However, if you want to make it a little more complex, you can also do a quarterly reporting where you can try to calculate the quarterly profit and try to calculate the quarterly EPS, basic as well as diluted. Now, this makes it a little more or a lot more complex, but what is the fun if there is no complexity? Barabar. So let us say if I were to calculate the basic as well as diluted EPS quarter wise, profits दिया है तो calculate भी कर लेते हैं. Each quarter is to be discrete. It is to be treated as an independent period. So over here, if I look at the basic, if I look at the diluted for each quarter of 3 months independently. Now the profit in the first quarter is given to you as 11 lakhs. Ajay, if I want the profit of the second quarter, so just for your reference, Q1's profit is going to be 11 lakhs, perfect. But when you look at Q2's profit is not 23 lakhs. 23 lakhs is profit for the 6 months. It is 23 minus 11 and hence this is going to be, I guess, 12 lakhs. The profit for the second quarter is 12 lakhs. When you go to the third quarter, on the other hand, there seems to be a loss on a total basis. Continuing, discontinued separate, but on a total basis, there seems to be a loss. It is falling by 4 lakhs and hence there seems to be a negative 4 lakhs loss on a total operation, out of which 4 lakh 50 is from a discontinued operation and hence probably continuing operation mein 50,000 ka profit hai. But on an overall basis there is a loss, and in Q4 there seems to be a profit of 10 lakhs. Okay, so this is one thing that you should be aware of. So over here, when you take the numerator in all of these cases, this is going to be 11 lakhs. This is also going to be 11 lakhs. Aja, now there are no shares actually issued during this period and hence this will be based on 10 lakhs only. If the current period were to be the end of the contingency period, then are any shares issuable? Well, there are no stores opened and hence nothing for the retail contingency, and for the earnings contingency or earnings, if the current period were to be the end of the contingency period, your earnings till date is 11 lakhs, and let us say it ends over here, in which case your earnings is 11 lakhs, and if your earnings is 11 lakhs, nothing is issuable on the earnings contingency as well, and hence यहाँ पे this is 10 lakhs. Sir, ये तो कितना easy है. हाँ चलो, यहाँ पे it is easy. From the next quarter you will have a nightmare. So in the next quarter this is 12 lakhs. Achha, we have figured out here 12 lakhs kaise hai, which is the profit of the second quarter. Achha, if you look at the second quarter, are there any shares which become issuable? Well, yes. Achha, these shares are outstanding for the entire quarter. यहाँ पे 12 बीच में नहीं लेके आना है. You are looking at only the quarter and hence you will have to take 3 by 3. Achha, in the second quarter, 5,000 shares are issued. When are they issued? On 1st of May, and hence they become actual shares. They are actual shares. For May and June, that is out of 2 months, out of 3 months, 2 months they were actual, and hence if we do this working, let us put this a little up now. If we do this working, this is going to be 12 lakhs upon, in the denominator this is I think 3667, yeah, 5,000 into 2 by 3, this is 3,333, so this is 10 lakh 3,333 for example, and that will give you the basic. So this is 12 lakhs divided by 10 lakh 3,333, which is 1.196. let us say this is 1.196. Acha, if you look at diluted EPS, okay, earnings contingency condition is not met. So for basic EPS, we will not even check for earnings contingency because till the year is over, the condition is not met. Retail contingency, you don't have to wait till the year of the end. The moment a new store is opened, you are supposed to issue shares. Now, when you look at the diluted EPS starts where the basic EPS ends. So this is 10 lakh 3,333 plus. What about potential shares? These 5,000 shares, if you look at only the quarter, in this 5,000 shares, these are potential for the last 2 months. These are actual for the last 2 months. However, if the current period were to be the end of contingency, then 5,000 were issuable. They were potential for the entire 3 months, out of which they become actual in the last 2 months. But then for the first 1 month, when they were not actually issued, there was still a potential, and hence we will take 5,000 into 1 by 3. This is something which is interesting. Acha, next, there's no other potential instrument, at least in the retail contingency, but when you look at the earnings contingency, under the earnings contingency, if the current period were to be the end of the contingency period, then your profit till date is 23 lakhs. If the current period were to be the end, then the profit that is earned till date is 23 lakhs, and hence 3 lakh shares become potential. They are not actually issued, but they are potential, because if the current period were to be the end of contingency, then your profit will be 23 lakhs for the total period, and 23 lakhs के basis पे आपको 3 lakhs divided by 1000 into 1000, which means 3 lakh shares become issuable, or 3 lakh shares become potential, and hence these will remain potential for the entire 3 months. So over here this will be 12 lakhs upon, if I take the total, this is I think 13 lakhs 5,000. 12 lakhs upon 13 lakh 5,000, and hence this is 12 upon 13 lakh 5, which is I guess rupees 0.919 or rupees 0.92 as a case maybe. Acha, in the third quarter there is some loss. Let us assume the instruments are dilutive. To be honest, if you do it in detail, you have to check whether the control number is falling or not, but let us assume for a simplicity for the timing that these instruments are dilutive, in which case if I were to calculate the basic EPS, the basic EPS is a negative 4 lakhs. This is for total operations upon, well, if you look at the actual shares in the quarter, the 10 lakh shares are outstanding for the entire 3 months. The 5,000 shares for the store that was opened in May are also outstanding for the entire 3 months, but now in the third quarter a new store is opened in September, and on account of which the shares become issuable in September, that is, they will remain actual for 1 month out of the 3 months. However, earnings contingency is not currently met, and hence earnings contingency पे तो zero ही आएगा. So over here this is going to be rupees 4 lakhs upon, in the denominator you will have 10 lakh 6,667. So this is 10 lakh 6,667, which will give you, let us say, 4 lakhs negative upon 10 lakh 6,667, which is I guess rupees a negative rupees 0.3750 if I'm not wrong. Let's say 5,000 into 1 by 3, which will be 1667 plus 10 lakh 5,000. Oh, I've taken 10 lakh 50,000, sorry. So over here you will have 10 lakhs plus 5,000 plus 1667. So this is, and you have 4 lakhs. So this is rupees 0.3974, let us say, negative. Let us assume that these potential instruments are considered to be dilutive. पहले वो dilutive है या नहीं, वो actually आपको check करना पड़ेगा, but let us assume they are. So over here this is rupees 4 lakhs only from your total operations, divided by, you start where the basic ends, so that is 10 lakh 6,667. For the 5,000 shares that were issued in the month of September, they remain actual for 1 month. However, if the current period were to be the end of the contingency period, then they were potential from the very first day, but they become actual after 2 months, and hence they remain potential for the first 2 months. So this is plus 5,000 into, let us say, 2 by 3. And what about the earnings contingency? If your current period were to be the end of the contingency period, your earnings till date are 19 lakhs, which is less than 20 lakhs, and hence no shares are to be issued for the earnings contingency. So your potential equity shares, if you go to see over here, are 3,333 shares over here. So this is 4 lakhs negative, and this is probably 10 lakh 10,000. So this is 4 lakhs negative upon, let us say, 10 lakh 10,000, and as a result, if we find a number, this is 4 lakhs divided by 10 lakh 10, and hence this is a negative rupees 0.3960. Why are we taking more decimals? Just so that I can elaborate, and I showed to you that apparently your loss per share reduces. Ideally your loss per share reduces, तो यहाँ पे आपका बत्ती जलना चाहिए. If your loss per share is reducing, that is, these instruments should actually be anti-dilutive. So the question arises that should you take the 3,333 in the diluted EPS calculation because it is reducing the loss per share? Well, we will take it only if it is diluting the control number. 4 lakhs is your total loss. So we can say your total loss is 4 lakhs, out of which you have been told that 4,50,000 is a loss which is pertaining to discontinued operation. And as a result, if I look at the continuing operations, there must be a 50,000 profit. अगर 50,000 का प्रॉफिट है तभी तो जाके नेट 4 lakhs का लॉस हो रहा है. If there's a 4,50,000 loss on the discontinued operation, and if there's a profit of 50,000, and if I have to calculate the EPS from continuing operations, so your basic EPS from continuing operation, you will divide this by 10 lakh 6,667. So this is 50,000 divided by 10 lakh 6,667, which will come to, let us say, 0.049668, let us say. However, if I were to look at the diluted EPS, in which case you will take 50,000 again for the continuing operations. 50,000 again, divide this by 10,10,000, that is including the 3,333 potential shares. So we are asking that should they be included? So let us say 50,000 divided by 10,10,000 will come to 0.4950. So basically this reduces or it dilutes EPS from continuing operations, and hence therefore the 3,333 potential shares, potential equity shares are dilutive in nature, and hence they should be included in this calculation for total as well as basic, and hence यहाँ पे अपन ने include करके रखा है. This is just for your understanding. Sir, परेशान हो गए? Yes, I can understand. My sympathies are with you. And in the last, you have 10 lakhs. Now the shares become actually issuable. But they become issuable from 31st December or from 1st of January as a case maybe, and hence this is 10 lakhs which is outstanding for the entire 12 months plus 5,000 that was for the shares issued in May, which is outstanding, not 12, for the entire 3 months, plus 5,000 which was issued in May, also outstanding for the entire 3 months, plus 5,000 which was issued in September, also outstanding for the entire 3 months, and hence this is 10 lakhs upon 10 lakh 10,000. For the earnings contingency, nothing is issuable still. So this is 10 lakhs upon 10 lakh 10,000, which is, let us say, 0.99. Achha, now when you look at the diluted EPS for the fourth quarter, you will start with the basic EPS ends, that is 10 lakh 10,000. However, if the current period were to be the end of the contingency period, then 9 lakh shares are potential, and they are potential for the entire 3 months, and hence this is 10 lakhs upon 19 lakh 10,000. They are potential for the entire 3 months. You have not actually issued it, but if the current period were to be the end of contingency period, then these 9 lakh shares become issuable, and they are potential from the very first day, and hence this is rupees 0.52, which is lower than the basic, and hence we consider this to be dilutive. सर अभी हमको कुछ भी एक्स्ट्रा नहीं पढ़ना है, हमको ब्रीदर चाहिए. यस, मेरे को भी ब्रीदर चाहिए. So over here we get done with EPS IND AS 33. I hope you've enjoyed this. It's a fairly complex topic. अच्छा, just one more thing, चलो मेरे को याद आ गया, is in case of options, we have taken a situation where the entity was giving options to buy the shares. So question number 12, question number 13, question number 17, question number 20, in all cases, entity has issued options to investors whereby they can buy the shares, whereby the investors can buy the shares if they desire. Investors can buy shares if they desire. So these are called as call options written by the entity. So these are call options, that is giving a right to buy. Acha, is it possible that the entity issues options to investors where the investors can sell the shares? So over here, the entity can also issue options whereby investors get a right to sell the shares that they hold. Investors get a right to sell the shares they hold. In this case, the entity is writing put options. Sir, how does it matter? How will the solution change? Well, over here, the nature of exercise will typically be different. So, for example, if there are 1,000 put options which the entity has written, which means it has given a right to sell to the investor. So if the investor sells, the entity will buy. But if the entity will buy, let us say the exercise price over here is rupees 8, whereas the average market price, let us say, is rupees 5, for example. In which case, if the entity has to buy, then what will happen is, when you calculate the free element, यहाँ पे भी वो free element ही निकालना पड़ेगा. Sir, why? Because if the put option is exercised and you assume that the put option is exercised at the start of the year, then you will buy back the shares. But if you buy back the shares, you will have to pay money. In other cases, neither is there a receipt of money or payment of money. Here you will have to pay money. अच्छा, कितना पैसा पे करना पड़ेगा? You will have to pay for the 1,000 options. You will have to pay 1,000 into 8. You will have to pay 1,000 into rupees 8, which is equal to 80,000. But you don't have that 80,000. Because if there is a cash outflow of 80, there has to be also a cash inflow of 80. So here you will assume that you will issue shares from the market in order to finance the buyback. But if you issue shares from the market, this will be at rupees 5. And hence, if you were to issue shares worth 80,000, so this is 80,000 divided by 5, which will come to, let's say 80,000 divided by 5, which is going to come to 16,000. 16,000 shares. 8,000, sorry, bad mathematics. This is 8,000. So 8,000 divided by 5, you will have to issue 16,000 shares, and in return you will be able to buy back 1,000 shares. And at the end of it, you would have received 8,000, you would have paid 8,000, but then you have bought back 1,000 shares and issued 600 shares in the process, and hence there will be 600 potential equity shares. Institute has not even asked a single question on this, but just in case it comes, just lock this in your mind that in case of your standard options, what you do is, in order to calculate the free element, like in all of these questions, in order to calculate the free element, you take the number of options minus that options into exercise price upon the market price. यहाँ पे सिर्फ उल्टा हो जाएगा, opposite है. So here you will start with this term over here, and then you will take the options on the other side. Otherwise, वो number आपको negative 600 दिखेगा. If you solve, usually you will say 1,000 minus 600, and hence this will appear as negative 600, which will confuse you. वो गलत है. It is not a negative or an anti-dilutive instrument. It is dilutive. But here, because there are put options, you have a right to sell. सबका बत्ती गुल. You have a right to sell, and since you have a right to sell, that is there with the investor, you will as an entity have to buy. So if you are going to buy, you will need money. How will you get that money? There's a cash outflow. You're assuming notionally the put options were exercised, in which case there would have been a cash outflow. So that has to be countered by a cash inflow. And as a result over here, we will have a dilution. I think the indicators are loud and clear. We have to stop for a breather. Otherwise हम धरने पे उतर जाएंगे, strike पे उतर जाएंगे, ठीक है? So this is your basic understanding. It has never come in the institute, but it came across my mind. And before something else comes across, we'll stop for a 5-minute breather, a very well deserved one. And we'll go to the next standard on the other side.